That doesn't guarantee anything. Nobody can predict the bottom. But it does tell you this crash is following a pattern that's happened before. Bitcoin was worth over $120,000 last October. Today, it's sitting around $62,000. That's a 48% drop in 8 months. And most people online are giving you the same lazy answer. The market is just volatile. That's not an answer. That's a shrug. In the next 12 minutes, I'm going to show you the 6 real reasons this crash happened and what it tells you about how money actually moves in 2026. Let's rewind for a second. In October last year, Bitcoin hit an all-time high, somewhere around $120,000 to $122,000. People were calling for $150,000, even $200,000 by the end of 2026. Crypto Twitter was euphoric. Fast forward to June 2026, and Bitcoin has been cut almost in half. Ethereum is down about 35%. Smaller altcoins? Some of them are down 50%, 60%, even more. So what happened in those 8 months? It wasn't one single event. It was 6 things happening at once. And once you see all 6 together, the crash actually makes a lot of sense. Reason number 1, and honestly the biggest one, is the Federal Reserve. Heading into 2026, everyone expected interest rate cuts. Lower rates usually push people toward riskier assets like crypto and stocks, because cash sitting in a bank account isn't earning much. But inflation didn't cooperate. It stayed sticky, close to the highest levels since 2023. And the Fed kept rates parked around 3.5 to 3.75%. Some officials even floated the idea of hiking further instead of cutting. Here's why that matters for crypto specifically. Bitcoin pays you nothing just for holding it. No interest, no dividend. So when you can earn 4 to 5% just sitting in a treasury bill, holding a volatile asset that pays 0 yield stops looking smart. Money quietly rotates out. Reason 2 connects directly to reason 1. When interest rates stay high, the US dollar tends to get stronger because investors worldwide want to hold dollars to earn that higher return. A stronger dollar is bad news for Bitcoin for a simple reason. Most of the world doesn't use dollars. When the dollar gets more expensive, buying Bitcoin becomes more expensive too for international buyers. In Europe, in Asia, everywhere. Less demand pushing the price up. Reason 3 is one most people don't fully understand. Bitcoin ETFs. Back in 2024, the US approved spot Bitcoin ETFs, a way for regular investors to buy Bitcoin exposure through a normal brokerage account, no crypto wallet needed. Over time, more than $50 billion flowed into these funds. People treated this as a permanent floor under the price, a never-ending source of buying. But here's the problem. An ETF isn't a believer. It's just a wrapper. In the final week of May alone, investors pulled over $2 billion out of these funds, the largest monthly outflow of all of 2026, led by BlackRock's fund. When investors pull money out of an ETF, the fund has to sell actual Bitcoin to pay them back. That's mechanical, forced selling. And when redemptions keep coming, falling prices trigger more withdrawals, which trigger more selling. A feedback loop pushing prices lower. That's the mechanism nobody explains clearly enough. Reason 4 is smaller in actual dollar terms, but huge in terms of psychology. Strategy, the company run by Michael Saylor, the most famous Bitcoin believer on the planet, sold 32 Bitcoin in late May. About $2.5 million, which is nothing compared to the 843,000 plus Bitcoin strategy still holds. But this was the company's first sale in almost 4 years. And in crypto, symbolism moves markets just as much as math does. If the guy who built his entire company around never selling sells anything, traders read that as a signal. Confidence cracked, even if the dollar amount barely mattered. Reason 5 is what actually made the crash feel so violent. Leverage. A huge number of crypto traders don't just buy Bitcoin with cash. They borrow money to buy more than they can afford, hoping to multiply their gains. It works great when prices go up. It's brutal when prices go down. When Bitcoin broke below key levels, exchanges automatically closed out these borrowed positions to prevent further losses. That's called liquidation. In one 24-hour stretch alone, almost $2 billion in leveraged positions got wiped out. Each liquidation is itself a forced sale, which pushes the price down further, triggering the next round of liquidations. That's why crypto crashes always look so much sharper than stock market crashes. Stocks don't have nearly this much retail leverage sloshing around. And reason 6 is the one I find the most interesting, because it's not really about crypto being bad. It's about something else being really, really good. While Bitcoin was flat or falling for months, AI-related stocks have been ripping, some up hundreds of % over the past year. When you're an investor with a fixed amount of money to deploy, and one asset class is exploding while another is stagnant, you rotate. Capital that might have gone into Bitcoin in 2024 has been chasing AI stocks instead in 2026. Money doesn't disappear. It just moves to wherever the story is most exciting. So here's the part that actually matters. Not the news recap, but what you do with it. None of these 6 reasons are about Bitcoin's technology breaking or crypto becoming worthless. They're about macroeconomics, interest rates, currency strength, fund flows, leverage, and where the exciting story of the moment is. That's a completely different kind of crash than, say, a company going bankrupt. Historically, this kind of cooling off period happens roughly 12 to 18 months after a major price peak. And previous cycles show it can take months, sometimes over a year, before momentum returns. That doesn't guarantee anything. Nobody can predict the bottom. But it does tell you this crash is following a pattern that's happened before. Is it a repeat of history or something different this time? Nobody knows for sure. That's the honest answer. If you're holding crypto, the question isn't, should I panic? It's, did I only buy what I could afford to lose? And am I using leverage I can't actually survive? Because the people who got wiped out this month weren't wiped out by Bitcoin falling. They were wiped out by borrowing against Bitcoin falling. That distinction matters more than any price prediction I could give you. Crypto crashes aren't new, and they won't be the last one. Most channels will just tell you it's volatile and move on. I'd rather break down the actual mechanics, because that's what actually helps you make a decision next time this happens, and it will happen again. If this kind of breakdown was useful, subscribe. I'm Wei Fin, and every week I take one confusing money or tech story and actually explain how it works. Let me know in the comments. Are you buying this dip or staying out? I'll see you in the next one.